Cup of tea and a biscuit for this video. None of my videos are scripted, and very few of them are edited now. And what you see is raw, straight from the heart, straight from the head, and unredacted. I decided not to do this video as a live stream because I don't want the distraction of live chat and comments. But in this video, I'm going to be talking about the deadly potential of unmanageable debt. And I'm not exaggerating, okay? I'm talking about people who end up taking their own lives because their debts get out of control. And how do we get here? Let me just rewind. I'm going to sip my tea because I'm nervous about this. This is a very, very delicate subject of which I have personal experience and knowledge. Last night, I put out a video because I saw this article. I saw an article in the Evening Standard saying mortgages as low as 3.35% launched to help struggling owner-occupiers, but there's a catch. And I looked at the catch and I saw that the catch was an arrangement fee or a mortgage fee or a fee, whatever you want to call it, that was basically 5% of the outstanding value of your mortgage lumped on top. And so low rate, interest rate, very high fee. And to me, this immediately smacked of exploitative lending. So there's a link to that below for anyone who wants to read the article. So I then went on and I released this video last night. And it's on YouTube, and it's on X, and it's on TikTok, where it's had approaching 50,000 views in under 24 hours on TikTok. 8,000 views. And I ranted. I was in the car. It was tired. I was tired. It was late. But I ranted. And I posted the video, and I ranted about how I thought that this was a loan sharky product. Like you can see there, the title is Skipton Building Society. Now that is inflammatory language. I'm fully aware of that. Because I really want people to wake up and understand how important, how sensitive, how delicate, and how potentially destructive irresponsible lending is. Now, this video kicked off a huge hornet's nest of reactions. Lots of people saying, oh my God, this is disgusting. How do they get away with it? How is it legal? And then lots of mortgage brokers going, hang on, Charlie, this isn't fair. Skipton aren't loan sharks. This is normal. It's just one of a big range of products. And for some people, it's the right product. And the most notable comment I got, which I'm going to go through here, was from Andrew Montlake, who is the mortgage broker that Martin Lewis always has on his TV shows, his money saving expert shows. And I want to just address the points that Andrew makes, okay? So let's just put it up there so you can all see it. I'm going to read it out. Seriously, Charlie, this talk is just plain incendiary. I accept that it's incendiary and wrong. I do not accept it's wrong. Skipton are not loan sharks. Okay, well, there's no technical definition of that, but I still stand by my situation, stand by my opinion that anyone that lends on this basis is basically a loan shark. And an excellent lender who have repeatedly tried to be innovative and help people. Okay, they've repeatedly tried to be innovative and help people, but only so that they can make profit from it. Every product is costed part on rate and part on fee. Yeah. Sometimes there's zero fee and there's just an interest rate. Sometimes there's a larger fee and a lower interest rate. And I'm aware that there's a dial, right? And Andrew goes on to say, this just turns the dial one way rather than the other. This just turned the dial one way. It's no big deal, Charlie. Okay, but It's how far it turns the dial. And for those who want to keep payments lower, maybe an option. Well, temporarily, it'll keep their payments lower, but ultimately, it makes their payments substantially higher. And this is my problem with it. Products like this need to be carefully advised. You're not wrong there. Compared to the alternatives and sensibly discussed. This gives people choice. Right. And in this video, I'm going to do comparison to a couple of alternatives to make my point. This is a regulated mortgage product. Yes, well, they all are. Not a fun review of a retail product. There was nothing fun about my video. And I wasn't even reviewing a retail product. I was reacting to a story in the news of a retail product. Andrew goes on to say, leave the advice on products to those qualified to do so. There are few things that make my blood boil more than being told to shut up when I'm trying to prevent vulnerable people from being exploited. I mean, even now, my blood is rising at that remark. It really, really upsets me. Because to make this point, either Andrew is unaware of how dangerous and ultimately potentially deadly, and I've got some official figures on this, right? So I'm not making it up. I will share them in a minute. Debt-related suicide, right? Either he's unaware of the fact that products like this specific product are the ones most likely to lead to that scenario happening, because only people in a desperate scenario would take this product. Or he's unaware, he doesn't care that that's what the case is. Now, I'm not saying that Andrew is a respected mortgage broker, and I get that, but this is what worries me so much. And he goes on to say, this is dangerous and scaremongering, comparing it to the nasty payday loans. No, I absolutely stand beside that comparison. Because what it is doing, because nobody who wasn't in financial distress would even consider paying a 5% of their, adding 5% to their loan balance just to have a short-term reduction of it. Nobody would ever do that. It doesn't make any sense. It's utterly financially stupid to do that unless you've got no choice. And this is where I line it up with payday loans, because the people taking payday loans, well, yeah, they have a choice. No, they don't. Why else would they choose to take such egregious high-interest loans out? Now, are there some people in very specific circumstances? And by the way, it's worth pointing out that this is a product that's only offered to Skipton's existing customers. This is a remortgage product only. It is not for new mortgages. And it's only for Skipton's existing customers. Now, why would they come up with this? I'm going to give a cynical answer, because I don't buy that they are an innovative and helpful company. And the reason I don't buy that is because they own Connell's, the largest estate agent in the country, and the way that that company conducts itself just rings all my alarm bells and sets my flags off about a toxic corporation, right? And these are the owners of that toxic corporation who own that estate agency corporation to sell more mortgage products, and will stop at nothing to make you take their mortgages over other people's. He goes on to say, this has been a norm in the buy-to-let market for a while now. Oh, right. Oh, how's that working out for the buy-to-let market? And works for many landlords. And he goes on to accuse me of, I know being controversial works and gets more views. Did that video really look like that's what I was doing? Did that video I put up last night come across as anything other than me being outraged at the existence of this product? Just give me time, guys. I've got to just make sure that I don't get carried away with myself here, because I'm very, very cross about this. Now, if there are people with a very small outstanding mortgage, and 5% on that is therefore a relatively small amount, and it's covering a very short time, at which point their circumstances change. Oh, there's some of those people for whom this might actually make some sense and save a little bit of money. Yeah, but even those guys are paying a 5% of the loan value fee, which is very, very expensive. Okay, I mean, the only upside of this product is a very small reduction in the monthly repayments compared to the best 2-year fixed rate that's out there that doesn't have a fee. And I will show you the numbers in a minute. Oh, why does this get me riled so much? This is how I felt when Purple Bricks first came out. I was taking money off people up front and then not selling their house. It just boils my blood when corporations, under the guise of, hey, they have a choice, they don't have to take it. We're just product choice. But when they actually, I mean, if they said, look, this is a very expensive product, it's only going to suit a very small number of people, because it is expensive, but it might just work out in some ways. Here's my cynical take on what I think they're doing. They know they've got a lot of mortgage customers coming to the end of a fixed rate and who are not going to be able to afford the new rate on their mortgage. Now, the only people who don't want to property to be repossessed more than the owner of that property is the bank. It's a nightmare for banks. It's an expensive nightmare for banks. And I know that there are people who think that actually the banks want to repossess all the properties. That's a whole other topic. But they would rather just have the money still coming in. And what this does, and the maths proves it, is that it puts those people into deeper debt at the end of that 2-year period. Whatever rates might be after then, they might be more, they might be the same, they might be less, it doesn't matter. The fact is, and I will show you, they end up in deeper debt because they have taken out a mortgage to pay an admin fee. So they end up in more debt than they started with, even though they've been making repayments. Let that sink in. They end up with more debt than they had to begin with. Extending the term of your loan doesn't put you in more debt. It makes it take longer and you pay more interest, but it does not put you into more debt. Some people will argue, well, this only affects people that can't afford to pay the fee. Well, if you could afford to pay that 5% fee, you wouldn't need to remortgage to reduce your payments, would you? You'd just be paying down your mortgage. So that's just a stupid suggestion. Nobody would pay that fee up front to reduce their monthly repayments by such a small amount. It doesn't make any sense. So the reason this is so important to me is because thousands, well, I'll share the numbers with you. So guys, I'm just going to warn you, I'm about to share with you some data about people taking their own life in relation to debt. And this is ultra sensitive. So please, don't continue watching if you don't want to see this. And if you're someone who's affected by this, I just urge you to go and talk to whoever you want to talk to about it. But if you don't have anyone to talk to about it, you go and talk to the Samaritans. But where is it? Let me just find here it is. So this is from a website called moneyandmentalhealth.org. It's a policy institute. And this is from 2019. And I'll put the link below to anyone who wants to go and read it. But more than 100,000 people, hang on a second, is that on the screen? No. Sorry. So there we are. It's the Money and Mental Health Policy Institute, okay? Financial difficulties and suicide. Taking a closer look at the number. This is from 2019, but this is the line. More than 1 100,000 people in problem debt attempt suicide in England each year. Don't tell me I'm scaremongering. So, I would like people potentially affected by this and mortgage brokers to understand that there are consequences of just saying, hey, it's fine, it's just another mortgage product. This isn't a hypothetical. This happens. And it is products like this that tip people over the tipping point from being in manageable debt to being in unmanageable debt. And this is why I've chosen my mortgage broking partners so carefully, because I cannot and will not have anything to do with people or brokers who are either too stupid or too cold-blooded to care about this problem. Okay, I know some people call mortgage brokers debt pushers. I don't agree with that. I see them more as advisors to people who are taking on a very major commitment that, if they're not careful, could go wrong. Now, debt is a drug. It is an addictive drug, and like all addictive drugs, if it's abused, it can lead to very bad scenarios. And there are too many mortgage brokers, in my opinion, who don't take this seriously enough and just want to borrow as much as you can and make as much as they can. And hey, buyer beware, right? Caveat emptor. No, in this case, when someone comes to you for advice, it is not. I mean, ultimately, of course, I always agree that it is a borrower's decision themselves to choose what they do and don't borrow. But as we all know, there are people who get maths and know how to do maths and know how to work out compound interest and the effect of that on their earnings. And then there are people who just don't. There are lots of people who don't understand even the fact that an interest-only mortgage means they haven't paid their mortgage off, right? There are official figures on that. So there are vulnerable people out there who will sign up to this because it says it lowers their payments for 2 years, who may not be aware of the fact that 2 years from now, it might push them into a situation where their debt is no longer manageable. So, you know, I still can't think of a scenario where this product is an appropriate product for anybody, unless it is because they are already in unmanageable debt. And if you're going to say to me, well, yeah, and so if they're in unmanageable debt, this might help them get out of unmanageable debt. Well, the gamble that you're taking is that with this very, very small reduction in their monthly repayments, because it isn't very much, they are suddenly going to find themselves in a better, stronger financial position before those 2 years are up and be able to take on what is now a larger debt and larger repayments. Let me just show you the numbers. Some simple calculations. Not done by me, done by a mortgage broker. Right. So what we've got here is on the top left, that block there is the figures for this Skipton low interest rate, high fee mortgage. And on the left-hand side, you've got 5 different scenarios of what their current loan is. And let's just take the first one, right? The £100,000 loan. So you add 5% on. So that's £5,000. It's just a fee. That's not £5,000 to put on an extension or a conservatory or a garage or improve your house or fix the roof, which would be an understandable reason for extending your mortgage. That's 5% just to pay the lender. And remember that all debt, you're just borrowing from your future self, but paying the lenders for the privilege, right? You're not borrowing from them, you're borrowing from your future self and paying them for the privilege. So you start off with 100 grand of debt, you're now suddenly in 105 grand of debt. But because of this discounted rate, your monthly payment is now only £600. Well, what would it have been? Well, the best no fee 2-year deal is on the right here. And for 100 grand, so without the 5k added to it, would be £687. So it's an £87 a month saving, which over 2 years is just over £2,000. Okay, so a £1,000 a year saving. But look what happens, okay? If you start off with 100k and stick to the no fee deal, then after 2 years, the balance remaining is £94,000. But if you take out this utterly scammy, sharky product that I don't like, after 2 years, your balance is £97,000. So you are in £3,000 more debt after 2 years with a £100,000 original loan amount than if you just carried on paying £87 a month more, which is the cheapest no fee 2-year deal, okay? And just by comparison as well, if you increase the term from 20 to 23 years, that would put your payment up by £19. But after 2 years, you'd be owing £96,000. So you'd still be better off than taking this 5% fee, which just makes the lender more money. Okay, and then all those other rows there are just other amounts. But in each case, the point is you end up in more debt after 2 years, and so you will be paying interest on that debt for the remainder of your mortgage term. So it's not just we're going to take a 5 grand fee. We're also going to take the interest on that 5 grand until you finish paying off your mortgage. It's interest on interest. But is it fee or is it interest? Well, you turn the dial, it's all just money that goes to the lender, but ultimately you're paying interest on the interest. And it's horrific. So I remain open to being given some precise figures, which does not result in an increased debt for the customer that takes this product. Because I've had quite a few mortgage brokers tell me that actually, no, Charlie, you're wrong on this, that this isn't that bad. This is quite commonly done. I know it's quite commonly done. I know that there are arrangement fees. I know fees can get added to the loan. I know that that happens, and I know that it's a dial that twists between fee and interest rate, fee and interest rate. I get that. But as with any drug, a small amount may be good, right? But too much can be fatal. So what I'm saying is that it is absolutely crucial that any broker advising a client on this makes 100% certain that their client will be in more debt 2 years from now, significantly more debt, than if they just carried on paying the best 2-year rate available for them. I mean, it's sharky short-term high-rate lending, any way you dice it. And this is secured lending. So my real cynicism is that the kind of people who are going to be struggling with this are also people who are likely to be, I mean, I know that they're offering it for people who've got 40% deposit. Well, 40% deposit, you mean equity. I don't know how many of those customers are going to be in financial difficulty or not. I would wager that people who've got 40% or more equity in their home are unlikely to be struggling. If they've lost their job and affordability overall, then this product isn't going to help them anyway, right? But people with 40% deposit are unlikely to be struggling. They're unlikely to need this temporary small reduction in monthly payments. So let's forget those guys. Let's look at the guys who've got 10% deposit, 90% mortgage. So the only people who would take this are people who reducing their monthly outgoings is the most important thing of all. Okay, does it help them avoid the loss of their home? That's like I said in the video last night. If you're that close to losing your home, and this is the only alternative to it, then congratulations, you qualify for our payday loan terms. We will absolutely nail you to the wall on fees and the profit that we're going to make out of this. We'll reduce your payment for you, but you're going to be in more debt to us at the end of this, meaning that if you're struggling now, you ain't seen nothing yet. You're going to be struggling much more in a couple of years' time. Maybe they won't. Maybe they won't. Maybe there will be some people who this will actually help save them from the loss of their home if things turn around for them. Maybe there will be. But my God, it's a big gamble. I'm going to wrap it up there. Thank you for watching. And please let me know what you think. Am I wrong? Do you disagree? And do you have a precise example of someone for whom this is a good thing? Because I can't think of one. Other than the people who are going to lose their home anyway and go, well, this might allow us to cling on to it a bit longer before we lose it. They're the only ones I can think of for whom this would be worth it. All right, guys, thank you. Sorry. Sorry for being so intense, but this really matters to me. See you in the next video. Bye-bye.